Hello, friends. This YouTube channel, Learn Finance and Accounts, is dedicated to the efforts put in by teachers and students in teaching and learning finance and accounts. In this channel, we'll be discussing different aspects of these subjects in detail. So, please watch the complete video, like, share, and subscribe to the channel. So, friends, in this video, we'll be talking about the approaches to study accounting. So, in the last video, I had promised you that we'll be studying accounting as per different approaches. These approaches are of two types. Two approaches are used. One is known as traditional approach and the second is modern approach. Now traditional approach is also known as British approach and modern approach is called American approach. Both traditional and modern approach are used to study accounts and these give the same result, but the modern approach is easier to understand. Now I have come to know from my experience that the students or the persons who want to learn accounting, they find modern approach a bit easier to understand. So we'll be discussing accounting through modern approach only. As per modern approach, there are five type of accounts. These are A, E, L, I, and C. A stand for assets, E stand for expenses. Along with expenses, we consider losses also. So when there are losses, their account is given same accounting treatment as expenses are given. So whenever we talking about expenses, then we talk about losses also. Third is liability, fourth is income and gains. So gains are different from income but same accounting treatment. Fifth is capital. Now what are all these? Let us talk about these in detail. The first account, assets. Now assets are what a business organization owns. A business organization can have cash, investment, accounts receivable, inventory. Now, what are accounts receivable? We'll talk about that. Inventory, supplies, land, building, machinery, vehicles. So, all these assets are known as tangible assets. So, assets are further divided into two categories, which are tangible assets and intangible assets. Tangible assets are those assets which we can see, hear, or touch. So, we can see cash, we can see a machinery, we can see a vehicle, building, land, inventory. So we can see all this. We can hear them, we can touch them. So the other kind of asset is intangible asset. Now intangible asset is the assets which we cannot hear, see or touch. For example, honesty of a person. When we say that person is a very honest person, this means the person has an asset called honesty. But can we see honesty? Can we touch or hear honesty? No, we cannot. Is it an asset? Yes, it is an asset. But we cannot see, hear, or touch. So it is intangible asset. Tangible asset and intangible asset. Two type of assets are there. Similarly, intangible assets can have goodwill or reputation. When we see the company has a very good reputation, it has a goodwill. What does that mean? That means the company is having an asset, which is goodwill, which is a reputation. Can we here touch or see it? No, we cannot, but still it is an asset. Similarly, copyright is an asset. Now, copyright, let me tell you, copyright is given on written works. So, if a person writes a book or a novel, the person gets a copyright over it. And any other person who wants to make a movie, suppose a producer director wants to make a movie on it, then that producer or director will have to contact the writer and ask for the permission. Now, permission, it is up to the writer to give permission or not. He can charge royalty also for giving that permission. So copyright is an asset. It is intangible asset. Similarly, patent. Patent is given for inventions. A doctor invents or makes a medicine for a disease. Then the doctor owns a patent for that medicine. Any company, any pharmaceutical company who wants to make that medicine will have to ask for the license from the patent holder. Trademark is an also intangible asset. So there are various intangible assets. Second type of account is expenses and losses. So an expense is a cost of operation that a company incurs to generate revenue. Suppose we spent $75 to produce or manufacture a commodity, and we sold the finished commodity at $100. So 100 minus 75 is equal to $25 will be our profit. Okay, so and if we sell, if we made for say $75, if we sold for $50, then we incur a loss. That 25 will be our loss. Next account is liability. Now liability is what an organization has to pay. What do you have to pay? You have to pay the bills. You have to pay for the expenses. You have to pay for the mortgages. You have to make payment for the payables means accounts payable. Now I will talk about account receivable and account payables. Account receivable, that we talked in tangible assets, and account receivable, sorry, and account payable we talked in liability. So suppose there is a shopkeeper. So people come to that shopkeeper and purchase the groceries from that shop on cash. Shopkeeper keeps on getting cash and selling groceries. Now, if the shopkeeper has to sell the groceries on credit, then he receives a check. A customer can go to the shopkeeper and tell the shopkeeper that I don't have cash, but please take this check, and you can encash this check next month. Shopkeeper takes that check. Now that check becomes account receivable for the shopkeeper. It is a receivable for the shopkeeper and it is a payable for the customer who has paid it, who has given the check to the shopkeeper. So this is the difference between account receivable and accounts payable. Accounts payable comes under liabilities and accounts receivable come under tangible assets. Fourth type of account is incomes and gains. Income is the excess of revenue over expense. We have already talked about this. If you manufactured a commodity for $75 and sold it for $100, then $25 is your gain, your profit. And your income is what is coming into the organization. How much money is coming into the organization? $100. Fifth one is capital. Now, capital is required to start or run a business. Whenever we have to start any business, for example, if a person has to start even a shop, then he or she requires money, and that money is called capital. Capital is the initial investment that you have done in start for starting the business, right? So there are five type of accounts: assets, expenses, liabilities, incomes, and capital. Now these five accounts A, E, L, I, C, they are given some accounting treatment. Now how are we going to give this accounting treatment? We are going to identify the transaction according to the accounts. Suppose there are two accounts in a transaction. One will be debited and one will be credited. We will apply a dual approach. Debit and credit, two sides are there. For every debit, there is a credit. So, two sided effect is there, and the amount on the debit side and on the credit side are the same. If one account is debited and the second account is credited, then the account on the debit side and account on the credit side are the same. Now, there can be two accounts on the debit side and one account on the credit side. So, the sum total of the two accounts on the debit side will be equal to the sum total of one account on the credit side. So, this is known as dual aspect. Now we are going to check our accounts and convert the transaction in such a way that it can be recorded in a journal. So what is the process? Process as per the modern approach is that we divide the five accounts into two groups. First one will be group A and second one will be group B. First one, group 1 or group A. Here we have two accounts which is A and E. In the second group we have three accounts which are LIC. So there were five accounts now. As you remember, AELIC. AE in one group, LIC in second group. Now we are going to give accounting treatment. In case of A or E, in case of expenses and assets, when they increase, the account will be debited. When A or E rises or increases, account is debited. When A or E falls or decreases, account is credited. This was for group number 1. For group number 2, again you see two arrows. When L, I or C increase, up arrow you can see up arrow, the account will be credited. When L, I or C falls or decreases, the account is debited. Now you can see that both the groups have opposite accounting treatment. In case of A or E, when it is rising up arrow, account is debited. In case of LIC, when it is rising, the account is credited. So can you see the opposite effect? This you have to remember. This you have to remember. Either you can write it on a piece of paper or you can store it in your mind if you have that photographic memory, then, or you can click a photograph if you want. You can click a picture or see, this is a YouTube, so this is a video. You can come back and see it again. So you can see replay this again and again whenever you want to check this process. So we are going to use this process in making our journal entries. Okay, so this was all about the type of accounts. Next topic, we are going to make journal entries based upon the process that we have just learned. So this is all for this video. Now you can support us so that we can continue making such educational content. So this is our QR code. You can support us. In the next video, we will be talking about journal. What is journal? Journal is a book which is used for recording financial transactions. So bye for now. We'll meet again in the next video. Thank you.